The one thing I want to ask you, and we talked about it at the beginning, inflation. Your mentor, you and I talked about this just a few weeks ago, Art Laffer, you were in your 20s, you were focusing on the economy. It was a time where inflation was off the charts and everybody thought it would consistently stay that way. Laffer thought differently, and we know, well known in the supply side economics. Here we are at another time where the markets, the volatility is often guided by our inflation expectations. Is inflation going to be a problem in your view?
And so what I believe is we are setting up for a massive period of deflation. Now, let me explain that. We got an employment report that was very weak relative to expectations. 235,000 increase in non-farm payrolls. The expectation, I think, was around 733,000. And last month, it was revised up to over 1 million. Now, we're trying to figure out, okay, what is happening here? Is it because of the Delta variant of the coronavirus and the pulling back of activity associated with that? Well, I guess this report corroborates that because leisure and hospitality employment was flat, and those numbers had been coming back very, very strongly until this month. So that's a probable reason. Is it because of supply chain issues? We're hearing about shortages, especially chip-related shortages, chips that go into everything manufacturing. Well, here too, we have some clues. Manufacturing hours worked were down 0.5%, which is a very big drop month to month. That's about 6% when you annualize it. So again, a big drop in a real indicator, not being influenced by inflation. Construction employment was also down. Again, there could be supply chain issues. I think what's beginning to happen is consumers, having bought a lot of cars in the last year to avoid mass transit, a lot of them being used, they're now sitting back and saying, okay, I've already got my car. So the inventory is not on the dealer lots. Many people were quick to tell me on Twitter that, couldn't I see the dealer lots are empty? Of course, there's a chip shortage, but maybe the inventory is in the consumer's driveway or garage. That's one thing that we think could be the case. Or maybe consumers are saying, for my next purchase, given the total cost of ownership has come down and is now below where gas-powered vehicles are, maybe I will buy an electric vehicle. And so there could be a pause in auto buying because of the technology shift that is underway. When all is said and done and the dust clears from the supply chain problems and everything, we're probably in a highly deflationary world. And we see three sources of deflation. One is very good. It's called technologically enabled innovation. Artificial intelligence training costs are dropping 68% per year.
Right.
When a cost drops that much, the demand for it picks up, and artificial intelligence is probably the biggest reason we're seeing the convergences between and among technologies. So we've got one S-curve feeding another, explosive energy, incredible deflation. That's the first deflation. Disruptive innovation, there's another side to it. It's called creative destruction. And I think we're going to see more creative destruction than we have in all history during the next 5 to 10 years. Now, you can say, oh, you're just talking your book. We have rights law teaching us about learning curves and cost declines that suggest we are going to see incredible booms out there in parts of the world, but it's going to mean tremendous destruction in others. So when I say confusing, I mean that. And then the third source of deflation, I think, will be cyclical deflation. Most people are fighting us on this one. It's hard to fight us given our research on those other two. But this cyclical deflation, it started with lumber, $1,711 in May. Now we're at $500. Copper, $490. I think now we're at $425. Used car prices are surprisingly good, and I know we're getting pushed back on this one too. They shot up 60% as everybody decided to avoid mass transit last year, right? And now we find ourselves supposedly in a chip shortage. I do believe in the chip shortage. I think we got a signal from Senator Manchin of West Virginia this week that he has a very important vote in the Senate, he thinks $3.5 trillion is just ridiculous, given that government debt to GDP ratio in the United States has already passed 100%. Before the pandemic, we were in the 75-80% range. So 100% is quite the marker. And he's also concerned about inflation and that a fiscal package of that magnitude might aggravate some of the inflation indicators that have been flashing red recently. I think that's a very good thing. If he is not for this package, it's not going to pass. I think he's much more for the $500 to $1 trillion pure infrastructure package. We just learned from Jolene Caruso that millennials are 70 million strong in our economy and now bigger than the baby boomers as a demographic. And I'm going to harken back to Stan Salvigson. Most of you won't remember who he was. He made one very important call in the early 80s. He said, baby boomers are going to be the reason that the equity market goes up for the next 20 years. It was a brilliant call. He's no longer with us. We're in the echo now. And I do believe that both crypto and the equity markets are going to be powered by millennials. In fact, Tom Lee, he has done the arithmetic the way that Stan did. And I think he says this bull market will not end at least until 2026 and maybe not until 2038 when the number of millennials peaks out there. Well, I went through it in the 80s and 90s and, nobody believed him, thought it was a ridiculously simple call. But when you look back in history, it was a pretty good call. We really do believe that we're setting up for growth and particularly for innovation to take off again. Now, why are we saying this? Well, innovation solves problems. And we saw what happened in the coronavirus crisis. Innovation took off, and we've talked a lot about it. And we've moved into much more of a digital world much faster than otherwise would have been the case. Well, what are the problems now? Well, price increases are a problem, and consumers don't like them. So innovation does solve problems. I mentioned the electric vehicles. They're coming down in price, and they're better performing cars. They're better for the environment and so forth. So we believe the price decline associated with EVs is going to help solve the auto pricing problem. Cryptocurrencies have taken off as inflation fears have flamed. Crypto is a better hedge, Bitcoin in particular, is a better hedge against inflation, if that's the fear, than gold. Gold supplies will continue to increase over time as Bitcoin's supply starts to diminish in terms of the rate of increase. In terms of our investment time horizon, 5 years. So we have to believe that one of the technologies, the 14 technologies around which we have based all of our research, is going to inflect within 5 years, or at least be discounted in the start to be discounted in the market as though it is about to inflect. So 5-year investment time horizon. Our minimum hurdle rate of return is 15% at a compound annual rate over 5 years. And so I think that that combination of 5 years plus exponential growth trajectories is what is finally starting to get into the market. I've been waiting for years.